Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome to the new year, Bob.
Indeed, the new year is on, and the stock markets are quite firm. As a matter of fact, very firm. And there's some story behind this, and we've noted for decades that you can have terrific bull markets for whatever rise up and conclude in the December-January window. And we've been talking about this for a while, and it worked for us back in 2017 with the Bitcoin bubble. That blew out on, I think it was December 17th or something like that. And then you had the fabulous gold and silver market way back that completed, I think it was January 20th of 1980. And then you had the Nikkei, fabulous Tokyo Nikkei stock bubble, and that completed on the last trading day of 1989. And so and there are others. I've checked them back. I think even the 1906 bull market that was followed by the rich man's panic, that's what they called it at the time, was a December or January turn. Oh yeah, and then the other one was the 1973-74 bear market. That was really a severe one. And the high on that one was, I think, January 11th of 1973. So the thing on this kind of a model, if you will, is you're looking for a high in the December-January window. So then you look at the stock market, yeah, it's up. Then the next step, you want to say, well, how high is it? And calculations such as price-earnings ratio are kind of unreliable, same as the the price-to-book value is another one that's kind of unreliable. But there are other ways of looking at it. And one we look at is the stock market relative to wages. It's at extremes. And the other one was stock market relative to commodities. And it is as high as it's ever got in the past. So by these two measures, oh yeah, the other one is relative to GDP. And that's high. So then the other part is the dynamics. And we've had a terrific rush in the stock market. And it is setting off our technical bells and whistles. And for our listeners, Jim, we should just kind of mention there's kind of two approaches we use. One is our own proprietary model that Ross developed, which is based upon momentum, and it's on senior indexes has been giving what we call an upside exhaustion. And you only find this signal at or near an important high in the stock market. So, and this is about 4 or 5 different parameters in it, but you can say it's basically related to momentum. And then the other one is a system that a guy in the States by the name of Tom DeMark has developed, and it's based upon a pattern, not momentum. So when you get two different systems saying this is exceptional. Now on the DeMark stuff, we get at a high what we call a sequential sell. So when you get a sequential cell with an upside exhaustion, it's kind of a belt and suspenders approach. You got two different systems saying that the market is very high on dynamics. So it'll probably take a tradable correction in here. And the other thing we want to look at, of course, is that it's been a very long bull market, and every bull market, as I came up with the quip some years ago, carries its own china shop, that the bull market creates such distortions, and it's not just in stocks, but you also have terrific speculation going on in the credit markets with the yield curve and credit spreads, which have been doing what they do at close to an important top in the stock market. And we can do a little more elaboration on those.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Bob Hoye. Bob, why are China's debt defaults ratcheting up again?
Yeah, well, there was a headline there January 2nd, and it's the same old, whereby you have a long trend of expansion in the economy. You have that gets into boom conditions, and then you have had a booming stock market, and everybody gets confident and borrows money, a lot of it. And then when the economy slows, or in the case if you're leveraged against the stock market, it stops going up, you've got basic costs, and then if the price goes down, then the power shifts over to margin clerks. So things like this headline about China's debt defaults are rocking up again. You got to pay attention to that one.
Why is it important for us to pay attention to it?
Well, because it's the writing on the wall. The credit markets and the economy are in important countries like China are changing. And we got one from England here, January 2nd. That British manufacturing output slides at the fastest rate since 2012. Now, if it was just a downtick of, say, a month-to-month downtick in manufacturing activity, you wouldn't mention it. But when the headline says it's the fastest drop since 2012, then you ought to take note of that. And then also the Baltic freight rate, Baltic dry freight rate, has taken a terrific plunge as well. And so you look at that one and you say, 2008, very straight up and then a straight down. And this one didn't get to the highs that was accomplished in 2008, but it did have a huge gain, and it's now coming down very steeply. So these are things that are beyond the control of any central bank. I mean, this is shipping rates. And the other things are production things. So these are warnings that we should pay attention to. But on the brighter side, on the longer term, I saw a really interesting headline about a gas field in or off of Israel, and they call it the Leviathan gas field, which suggests that it's huge. And it's in startup for production of natural gas. And the headline here says, now Israel is becoming an energy powerhouse. Well, this is obviously very good for the area because it's a stable business-like, constitutionally run country, and it may not be subject to the same political ploys that the people at OPEC with oil production play, where they have the audacity to think they can manipulate oil prices and continue to screw around and get everybody's attention. So that one is an interesting headline. What we're interested in is next week's or the weeks after headlines, and if you can get those right, you could really make money in the markets. But the thing that with this, Jim, is our history is that if you have a big financial party going in, and this is more than just a Santa Claus rally, going into the turn of the year, it can be working on an important high, and our technical readings are that this is very excited market, measurably so. And just to repeat that we've got it on both models, on a momentum-related model, and then also on a pattern-related model at the time of the year when important bull markets have concluded. So we'll watch this one very carefully. But the other one, which I was talking about before we got into headlines, was the credit markets, where the yield curve, and through the summer it dominated the media because the curve had inverted, and by that short rates, like Treasury bill rates, the front end of the curve had got higher than the back end of the curve. Now, typically, short rates are lower than long rates, but I think what happens is as the curve inverts, the demand for short-term funds by speculators drives the yield up. But then after some weeks of being inverted, the curve then moved away from inversion and back to more or less normally sloped. And then at that, some people who I think were kind of fresh to the concept of the yield curve then said it no longer inverted, so therefore the threat had gone away. But they haven't done their history. We've got the yield curve in the U.S. back to 1857, and one of the conclusions is that for all of those decades and decades, whenever the U.S. curve has inverted, a recession has followed. Forget the story at the time, whether it was 1873 or 1929, which all had wonderful stories, but the main thing is the curve inverted and said, hey, the game is going to be over, and then it does. So then the other one, credit spreads, where the difference between high-grade bonds and low-grade bonds, and then in a boom, everybody gets confident and reaches for the yield that you can get out of riskier investments, and that then narrows the spreads. And then when the spreads reverse to widening, of which it has, and we've had the two breakouts on reversing the trend to widening, and then that sort of put on a modest correction. But then there was good news with trade deals and in the U.S. employment numbers that were good, and everybody's buying the U.S. stock market, which is giving us this potential turn-of-the-year high. But underneath it, the yield curve and credit spreads have changed to, let's call it an adverse trend. And if you look back in history, that the Federal Reserve has absolutely no control over this, because it can be a simple thing. You say, okay, an inverted curve anticipates a recession. Therefore, if they flood the money markets, the short rates will go up. But they've been flooding the money markets lately because there was a huge liquidity hole discovered in the U.S. money market beginning the middle of September. So, no, I think there are warning things out there, Jim, and we should pay attention to them. We'll review them as they continue, and I'm sure they'll continue, because these, and then especially in credit spreads and the yield curve, have made distinctive reversals to an adverse trend. And throughout the whole history of the Federal Reserve, they've never been able to, they can manipulate short rates down, but they've never been able to manipulate or defer when the yield curve and credit spreads reverse to adversity. So, hey, this is very important warnings that the financial markets are providing.
We'll have more with Bob Hoye right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, do credit rating agencies kind of fudge the numbers to help themselves?
Oh, yeah. Yeah, I've been in touch with this one for, more than 30 years, when Canada did develop its own credit rating agency, because originally you had Moody's and S&P, and then you had the Dominion Credit Rating Agency in Canada. They are there to provide an independent rating on the quality of bond issues. But they're a business, so they have to build business, and the way they get their fees is by having those who are issuing the bonds contact them to get the credit rating. So it gets a little competitive. And what brought this forward was recently a couple of articles about collateralized loan obligations and various other things where they're again bundling up low-grade securities, and the theory is if you put enough of them together, it reduces the risk. And then in order for the underwriters to market these collateralized securities, they have to have a credit rating. And there's where the competition comes in to have a friendly rating. I mean, investors have to have the comfort that it is an issue of investment grade that they're buying. And so this is what the article was about, is that there is a little competition going on, so then perhaps the rating agencies are being a little more generous than they should be, rather than acting like a detective. So then I remember, again, about 30 years ago, talking, for a while I was meeting one of the head guys at the Dominion Credit Rating Agency, Dominion Bond Rating Agency, I think it was called. So I said to him, when you're in a bad credit market and the price of bonds are declining and the quality of bonds also declines, and then you get into the rating agencies cutting the ratings. And then I said, what do you do when you get down to just a tick above, when it's like a triple B, you're at the last level where it's still considered an investment grade? And he said, well, they were reluctant to be the ones that do that cut, because then all of a sudden the bond funds that are holding investment-grade funds, and they have rules, and so they have to then sell the non-investment grade bond, which creates a disaster. So then they're unwilling to make that final cut until after the disaster is really apparent. So it is worthwhile in a theoretical world to have bond rating agencies, but we should also understand that at booms they may be generous, and then when you're in a contraction they may be slow to move. So maybe you want to do your own credit rating agency, and which nobody has got the time or effort to go through all the accounts. But you can just say from now on, hey, I'm out of all lower grade bonds to solve your problem, and this is what we would do now is reduce exposure to lower grade bonds across the board.
Bob, thank you so much for chatting with us.
Well, there we are. We've done the first edition of the new year, and I look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Happy New Year, everyone.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.